Welcome back, students, to our second lecture of chapter number 9 about depreciation. So that's where we stopped at exercise 9.1 and 9.2. So now we will continue from further about classification of depreciation. So basically we have two types of depreciation: economic depreciation and accounting depreciation. Now, economic depreciation we have just discussed, right, that it's a gradual decrease in the utility of an asset with the use and time. It could result because of a physical depreciation or because of a functional depreciation. Physical depreciation basically result because of interaction with the environment, because of resting, right? So it could be any reason that the life of asset has been decreased. Now, functional depreciation, basically it results because of changes in technology, right? Or as a result of that technology, the use of asset has been let's say decrease or eliminate, right? So this is what we call it functional depreciation. So economic depreciation, we already solved question 9.1 and 9.2, right? Now we will look at accounting depreciation, right? Accounting depreciation, this is basically what we will use it also in economic engineering economic decisions as well as in financial statements. Now, in accounting depreciation, basically it's an systematic allocation of assets value in proportion over its depreciable life, right? What I mean by systematic allocation of assets value, if you remember this example, let me show you. Yes, this example which we discussed last time, right? You can see here that how the total cost of this baggage handling system, 100,000, has been divided for 20 years, right? 5 million in each year, right? This one, depreciation each year, 5 million, right? So at the end you have book value, and we continue until we have the book value of 0, right? So that is what we call it accounting depreciation, right? So this was the systematic allocation, right? And it has under depreciation you have normally this accounting depreciation is for we call them fixed assets, right? Those assets which are capitalized. The term is that the cost of these assets are distributed, right? Basically by dividing this cost, their cost as an income, right, as an expense item. We call it depreciation expense, right? So basically this systematic allocation of initial cost of an asset in parts over a time, this is what we call it accounting depreciation. Okay, now how we calculate? There are two types of accounting depreciation. One is book depreciation, and another one is tax depreciation, which is calculation of depreciation for tax purposes, and this is for accounting purposes. So what we will cover only this type, the book depreciation, in our chapter. Now, why do we consider depreciation, right? Remember, this is what we said, that in income statement, depreciation is revenue minus cost of goods sold, gross profit minus expenses, and one of the expenses item is net income, right? Like this is the same thing. If you see here the net income statement, right, one of the expense item here is, rent expense is a depreciation expense, right? So this is what we mean by expenses, right? This is the same explanation. Gross income minus expenses. What is gross income? Is gross profit, right, minus expenses, and one of the expense item is depreciation, right? Then we calculate taxable income minus taxes, and we have net income, right? So with this, depreciation is basically considered as part of business expense, and it reduces the taxable income. right? If you put some number here, definitely this number will be reduced. Now, what are the factors to consider in asset depreciation, right? This is what we call it, a process of depreciating an asset, right? It requires that we need to understand some very basic terminologies, right? This is very important. First part, which we call it, what is the cost of the asset which we are going to depreciate, right? Or we call it, what is the cost basis, right? This is what we need for a depreciation purposes, right? We need to have what is cost basis. Now, cost basis is, for example, you purchase a machine or equipment. Let's say you purchase something from China, right? And you paid, let's say, 10 million. But not only that is the only cost, plus there is a transportation cost, bringing that equipment from China to Jubail as an example, plus installation cost. Let's say you need to make a site preparation cost, installation, training cost. So these are all costs which you need to recover. This is what we call it cost basis, or we call it depreciation basis. I'll explain later with some examples and question as well. Then another one is important thing you need to know in depreciation is what will be the value of that equipment or asset at the end of its useful life. Means what will be its disposal value, what you are going to do when the useful life finishes. Are you going to throw it, or you can sell it to someone and receive a cash, or means you can get a cash inflow, or you may pay some money to someone in order to remove that one, right? So salvage value can be cash inflow, means when you receive a cash from an old machine, or could be a negative when you pay someone to remove some equipment at the end of their useful life, right? So this is what we call it disposal value. So normally in our questions it is mostly cash inflows, right? And we know that the salvage value we get it at the end of a useful life of the project. Then we need to know what is the life of this asset which we want to depreciate, how long we are going to use that asset. Is it 5 years, 10 years, 20 years, whatever. And then what is the method of depreciation, right? What is the method of depreciation? And for example, here in this example we simply divided this cost by 20, right? This method is, we call it a straight line method. There are other methods as well which we will discuss as well. Yes. Then the method of depreciation which we are going to use, right? And we have different methods of depreciation. We'll see it later on. So what we need to do is just summarize for a depreciation. You need to know what are the total costs, right? Or we call it cost basis, which we need it to calculate a depreciation. Salvage value, value of the equipment at the end, life of that asset, and the method of depreciation. These are the factors which you need in order to calculate any asset depreciation, right? Now next thing is what can be depreciated, which assets can be depreciated, right? Remember, we have account receivable, we have inventory, right? Now which asset need to be depreciated? And first of all, the very basic concept is only fixed assets will be depreciated, right? We are not going to depreciate inventory or supplies or those other current assets. Always you have a non-current asset which you will depreciate, right? So the basic criteria is that the assets which is going to be used in a business or held for a production of income, these are the one you should depreciate. And asset having a definite useful life, right? You should know the useful life. Is it a 10 year, 20, even 30 years, right? You must know the life of the asset. If you don't know it, you cannot depreciate. And then those assets must wear out because of obsolete, or they may lose value. Not like land, right? Land is not depreciable. Land is land. Land is going to stay there. Yes, building on the land is depreciable, but land itself is not depreciable. So this is very important. Land stays there, right? Similarly, inventory is not depreciable because it is a current assets, right? Okay, so any asset which satisfy these three conditions are the one which are going to be depreciated. Next, how we are going to calculate the cost basis, right, which is a total cost that is claimed as an expense over the asset's life, right? Now this cost basis normally include the actual cost of asset and all other incidental expenses. Incidental expenses means transportation expense, site preparation, installation, all. These are what we call it cost basis, right? Now in order to explain further, right, I'll explain you with some example, right, and exercise 9.3. I'll show you on what is exercise 9.3. Yes, if you're coming back here, the exercise 9.3, right, and the general service contractor company paid 400,000 for a house and lot, right? Just open new one, right? Right. So yes, now this contracting company, you know, they paid 400,000 for a house and a lot, right? So total someone paid is 400,000 for house and lot, right? The value of the land was appraised as 155 and house was 245,000. So what it says basically that you are purchasing you know, what you have done is you purchase something, right, a building which had an open area and an old building. Basically you purchased an old building where you have some land, right, and you have a building. So this is what you have paid. For land you paid was 155, right, for land, and the building, there was a building on what you have purchased, right, 245,000. So this is what is given. So you purchased a land and building by paying 400,000 is the total amount, and what you have calculated is that the value of land and building separately is this one, but the total, if you add these two, is 400,000, right? Now what else is given? The house was then torn down at an additional cost of 15,000 so that a warehouse could be built on a combined lot at a cost of 1,250,000. Okay, so what we have done is we purchased a land, building, right, as well as, and then we need to demolish old building, right? Remember this is an old building which you need to remove in order to make right? Or you can call it a site preparation cost if you are in civil engineering, right? So site preparation cost. Demolish means you need to remove the old building, right? When you remove the old building, you have to pay someone 15,000. Right? This cost is to remove the building. This is additional cost. And then once you remove old building, now you have an empty land. On that one you will construct a warehouse, right? Warehouse, you will, the mustauda, you will construct a new warehouse which will cost you 1,250,000. So this is our situation. Yes. Right. Now this is what is given, right? 1,250,000 is the total cost on constructing a new warehouse. What is the value of property with warehouse? First, they say what is the value of this property. Second, for depreciation purpose, what is the cost basis of the property? Okay, so now this is what is the situation now, right? Now this is the scenario. Now the question says what is the value of a property from this one, right? What is the value of this property? You purchased something, right? It's your property, right? You spend money. You spend this one, you spend this one, you spend this one, right? So what is the value of a property which you need to calculate, right? And then second part of the question says, right, what for depreciation purpose, what is the cost basis of the warehouse? I'll come to our slide. Yes, now this is what is the same thing, right? So what is now the original cost of the land is 155, right? This is a solution. 255, this is what we already know what we paid. This was the value of new building. This is the demolition expense. So now what is the total property value? Is this one, the whole is our value of a property. But the question was, second part of the question, this is the first part. What is the value of property? Land plus the whole building. This is what you have. But which cost you are going to depreciate for accounting depreciation? Remember, we said that land you cannot depreciate, right? Okay. For building, you paid something which was there, right? There was a building on this land, but that building is no more there now. It's removed, right? Because this demolition expense says you remove the building. So now what you have left with this demolition cost means a site preparation cost plus cost of new building. This is what you should recover in accounting, or this is what you should depreciate, right? 15,000 plus 1,250,000. So this is basically cost basis for depreciation. So this is how we do it. Question 9.3. Now I'll explain again with some more detail on exercise 9.4. Understand another one. To automate one of its production processes, the Milwaukee Corporation bought 3 flexible manufacturing cells at a price of 400 each. Remember, be careful when you look at these numbers. 400,000 each, and how many manufacturing cells you bought? 3. So basically your purchasing cost will be 400,000 times 3. Be careful, right? When they were delivered, Milwaukee paid the freight charges of 20,000. Freight means transportation charges. Handling fees, maybe at the port, at paying something to customs or Jamaica duties, is 15,000. Site preparation is 45,000, right? 6 foremen, each earning 20 an hour, worked 5 40-hour weeks to set up and test the manufacturing cells. Special wiring and other material applicable to the new manufacturing cells cost 3,500. Determine the cost basis for these cells. Basically this is the question, to calculate what is the depreciation cost. Remember we said that in depreciation, cost basis, right? Cost basis, I'll show you here, is the total cost that can be claimed as an expense over its useful life, right? It includes transportation cost, site preparation, installation, training, all this one, right? So if I put all those numbers here, right? So just putting the numbers here, flexible manufacturing, you have one machine cost 400,000, so times 3 is the total cost of machine. These are the freight charges or transportation charges, handling fee, this is given, site preparation, startup and testing, and this one is startup and testing cost, right? It was given that there are, you can see here from site preparation, right, for setup and testing cost, right? 6 foremen earning 20, so 6 times 20 times 40, because it's an hourly rate, right? So 6 times 5 times 40 times 20, this is the cost of those foremen, right? 24,000, right? And special wiring and material 3,500. What is the cost basis? So this is 1,307,500. This is the cost we need to recover, or the cost we need to depreciate. This is what we call it, cost basis. What I recommend you is to look at example 9.1 as well. It is similar, so to see it just for your own practice. And this is also here, so just try it by yourself. It is similar, so I am not solving it here, so you can have it on in your own practice, right? Okay, now only item you need to consider in this question here is that the tax amount, right? They purchase a hole punching machine 62,500, and vendor's invoice include a sales tax of 3,263. So basically in this amount you have already included the tax, right? Just like the riba or VAT, when we pay it in the final amount, it was included. So this number has this much as a tax. So if you don't have to put this as separately, remember, be careful. This tax, because it's already included in that, in invoice it included a tax as well, sales tax, right? So this already include a sales tax, so you don't have to put here again the same amount, right? And the rest is easy. So this is a cost basis of it. You can just read it and solve it on your own. It's easy. Similarly, example 9.2, which is a little bit change, where we have a trade-in allowance, right? Now what is a trade-in allowance in example 9.2? Just to explain you, trade-in means, you know, when you purchase a new car by giving an old car as an example, right? If you give an old car and you want to purchase a new model, they may give you some discount, right? So that trade-in allowance is what we call it, a trade-in allowance, right? Now let's say in this example, same example 9.1, right? Same information, right? We already calculated cost basis for that one. Suppose same linear purchase the hole punching press by trading in a similar machine and paying cash for the remainder. So what they have done is they have traded a machine, you know, by giving an old machine and taking a new machine. And what was that trade-in allowance? Is 5,000, right? So what was the trade-in allowance? Was 5,000, and the book value of the hole punching machine that was traded is 4,000. Determine the cost basis for this hole punching machine. To explain this one, just let me go back to the same Excel which we discussed before here. Yes. Now see, this is the book value. Remember what is the book value. So if you don't remember, just come back to this explanation and check. Now book value is 90 million, right? So remember, if you purchase something or you replace a machine, this machine with the new one, and if you get a discount on machine less than this amount, right, it means there is a loss, right? If you make if you get a discount more than this amount, it's a gain, right? Now in this example, what is the trade-in allowance, right? I'll show you, right? This is example 9.1. we already solved it, right? There was no trade-in allowance. Now example 9.2, where there is a trade-in allowance. So for trade-in allowance, first thing we need to calculate, do we have let me use the same one. Let's say for this question, what was the book value? Book value of the old machine which we are going to trade now, right? The book value of the old machine is, sorry, in example 9.2, let me go back and say, yes, book value of old machine, right, 4,000, right? So book value of old machine in this example is 4,000, right? So this is the value. If you can sell it to someone or outside, this is what you are going to get it, right? This is what we call it our so this is the book value. Now if we get a discount more than 4,000, means we are in a good deal, we made a gain, right? But if we get less, there is a loss, right? So let's see what we get it here, right? Do we have a gain or loss on the trade-in allowance, right? Do we have a gain or we have loss, right? So this is the value of our old machine. So what they are giving, how much discount they are giving us? They are giving us a discount of, means trade-in allowance of 5,000. So basically you are replacing an old machine by a discount of 5,000, right? So it means it's a good deal, right? We have a gain, right? So we have a gain of 5,000. What if they give us a discount of 3,000? Then in that case we have a loss, right? But this gain or loss, it is, we call it unrealized gains, means they did not give us the money, flus, right? It's just they give us a discount on purchasing a machine which has a book value of 5, right? If you get something for 3,000, it is a loss, right? So 5,000, right? So what is the gain here? Basically, if you take a difference, what is the gain? This is the allowance, and the gain will be 5 minus 4 is 1,000. So this is what you are getting, right? So our gain on trade-in allowance of 5,000 is okay. So this one is our gain. So 1,000 is the gain. If we have here this one, we will have a loss, right? So now what we need to look at, so basically how much you are going to pay, right? So you are going to pay them the less amount, right? See, I'll just explain here. Now see, what will be the cost of new machine now? This is the old book value, trade-in allowance of 5,000. So we have an unrecognized gain. This is what we call it. Just I explained you in that Excel file. Unrecognized gain is 1,000, right? And the cost of new machine is this, right? 62,500 minus 1,000 as well. Remember, we are paying less amount because we had a gain on old machine. So we are going to pay them the less amount, right? Because a new machine, as a result of giving old machine, we get a 1000 extra profit on trading in the old machine. So what will be our cost? 62,500 minus 1000, then all numbers are what you have is same. So now the cost of machine basis is 67,875. So this is needed when you have a trade-in allowance, right? When you are replacing an old machine and getting some discount. In that case, you have to see whether you have a gain or loss. So I will summarize. When you have a gain like this one, you minus it from the cost, right? What we have is a gain, right? This one. Imagine instead of this one, they give a discount of 3,000. In that case, you have a loss, means loss of 1,000, right? 4 minus 3, 1,000. In that case, if you have a loss, then what will happen? In that case, here you have to add, because this your cost has been increased. You have you have a loss on old machine, so you need to add that to the cost. So just be careful. I'll repeat again. When you have a gain, you deduct it. When you have loss, you add it to the cost, because it is all cost. So be careful. This is an important information for this one. Now similarly, right, this is a same example. Let's say if trade-in allowance is 3,000, like in this case, right? If a trade-in allowance is 3,000, then what we are going to do, right? In that case, you have a loss of 1,000 as a result. So you come back here and it should be plus. Then the cost will be like this one. You can check it by yourself as well. Exercise 9.5 is the solution is here. I'm not going to discuss, so you can solve it on your own and see if you can understand or not. If you have any confusion, please send me an email. Same thing for 9.6. They are very similar and easy to understand. So this is the end of our session for lecture number 2. If you have any question, please feel free to send me an email or WhatsApp message. Best of luck. Thank you very much.